very good morning to everyone. Welcome to today's webinar. My name is George Radford and I'm delighted to be your host. Today we are going to have a quick look at the UK property market, provide an update on how the market has performed. This webinar is specifically for our Nigerian-based clients. However, the content will be relevant for any UK property investors. So by way of background, I've got over 20 years of property investment experience. I'm a chartered surveyor and I've worked with clients in the Africa region for over 15 years. I've been traveling to Nigeria now for over a decade and very much specialize in helping clients in the Africa region invest in UK property. So in terms of what we're going to cover today, a quick look at how the market fared last year. We'll have a look at how the market is set to perform this year and how it's already performed year to date. And we'll have a quick look at some of the best places to invest currently. And we'll do a Q&A session at the end of the webinar. You should see the chat box. Please do feel free to submit any questions you have for me and I'll endeavour to answer those as we go or at the end of the webinar. So yeah, we've got quite a few people who've joined now, so I will continue. But a very warm welcome for those who've just joined as well. So just in terms of background on the RPA Group, so we're a global business. We've got offices in 4 continents. And quite simply, our focus is to assist clients anywhere in the world to invest in the UK property market as efficiently and effectively as possible with a view to optimizing their return on their investment. In order to achieve that, we provide an end-to-end investment solution. So at the front end, obviously research and due diligence is very important in any investment. So making sure that any product that we bring to market is with the best developer and it's the best product in market with a view to delivering the strongest returns. We like to understand our clients' financial circumstances and their personal circumstances and what they're trying to achieve. Once we've done that, then we would look to recommend a product that most suitably meets their investment requirements. Once we've identified that product, then we will facilitate the legal process, the conveyancing process, as we call it in the United Kingdom, the mortgage process as well. So that would be helping clients to get finance for the investment, to get a mortgage, either directly with the bank or using our network of mortgage brokers. And then at the back end, our lettings and management service based here in the UK will directly manage our clients' investment portfolios, meaning we've got full control over our clients' assets, which eliminates problems. And then when clients wish to exit, we will resell the property for you back into the secondary market. Sorry, wrong way. This shows we're live. So in terms of how the market fared last year, so as everyone's probably aware, last year was quite challenging, I suppose, for the global economy. Negative impacts from the Ukraine war, probably still an aftermath from COVID, still some supply chain challenges, and inflation really was running riot. And the central banks and governments were really struggling to keep it under control. That naturally caused a significant and sharp increase in the central bank lending rates globally, which had a direct impact on the cost of borrowing for mortgages and therefore had a negative impact on the performance of global property markets, quite simply. Not just for people's ability to service their mortgage because they became a lot more expensive, but also just the cost of living, so people had less money to spend, quite simply. The UK market didn't fare too badly, though. A lot of people were a lot more pessimistic about how it would do with some of the headwinds. Overall, negative growth of 1.1%. and some markets outperformed, which we'll have a look at in a minute. Why did the UK market hold up, reasonably well? The strength of the labour market was one of the primary drivers, and the strength of wage inflation. There was a slightly more flexible attitude from lenders, from banks to borrowers in terms of the mortgage payment terms, and then a lot of the stress testing that was put in place by banks and the UK government, I suppose, post the global financial crisis, lent to more responsible lending and more responsible borrowing, which ultimately meant that if people's interest rates increased significantly, they were still in a position to service their debt. The rental market performed remarkably well. Overall increase across the country of 9% average increase in rental values for last year, which is the best performance the UK rental market has ever had. We focus on new build developments, off plan, typically new build developments. And what we just made a note of down here is how the new build market has significantly outperformed the secondary market. To give you an idea, the average price of a secondary property in the UK is about £285,000. The average price of a new build now £425,000, and significant growth that we've seen, 20% increase on the year before. So that's from 2023. So from 2022 to 2023, depending on what figures you're looking at, we saw very positive growth on new build properties. So very much outperforming the market. Why do I think that is? It largely, I suppose, because people are willing to pay more for new build properties, both from a capital perspective, but also from a rental perspective, because they offer so much more for people. They're modern, they've got modern connectivity, they come with warranties, and so on and so forth. So that's some of the reasons why, as a business, we very much favour the new build property market. So let's have a look at Knight Frank's view. So shows how the outlook changed really from some of the major property investment houses around the world. So Knight Frank being one of them. In October last year, negative growth of 4% forecasted for 2024. And in January this year, they revised that to 3%. So quite a significant shift of 7%, showing how their attitude changed very much from being pretty pessimistic, shall we say, to rather positive. And that's what we've seen across the board. And the main reason for that is that inflation has become very much under control. The figures today came out for UK inflation. It's 4%, which is great. Government's target is 2%. And what that's meant is that the Bank of England has halted their base rate increases. And we're very much expecting those to start coming down now, which will reduce the cost of lending for borrowers, which will have a positive impact on the market. And just on the ground here in the United Kingdom, there's just renewed confidence and a lot of positivity in the market. Everyone's very optimistic about the outlook for this year and beyond. So what have we seen? To kick the year off, we've seen asking prices increase already, 1.3%. We've seen 20% more sales agreed in January 2024 than January 2023, 15% more properties on the market. So people really confident it's a good time to be putting their property on the market now, and the most amount of mortgage products on the market for 15 years. We'll have a closer look at growth figures in a minute. London, you'll see, from a capital growth perspective, sort of being outperformed by the northern cities and cities of the Midlands. But it is worth noting that central London still offers fantastic value, and it's still 17% lower than it was in mid-2015. So albeit maybe London's not going to offer that 20% growth like some of the northern cities will over the next 5 years, still looking at anywhere from sort of 14 to 17%, depending on what figures you're looking at. For London, it does offer a very good value buying opportunity compared to where it has been in the past. And a very strong rental market as well. So if we have a look at the different regions, so the Northwest is forecast to grow 20%, same as the West Midlands. East Midlands a bit behind, 19.6%, and then the Southeast and London. This is Savills, that's why the figures differ from the previous slide. 16% for the Southeast and just under 14% for London. What I would say is the UK is very much suffering from a housing crisis still. We need 300,000 new homes a year to keep up with the housing demand. And we're typically having a shortfall of anywhere from 100 to 150,000 units a year. So what that means essentially is there are not enough houses every year, 100 or 150,000 houses short to cater for local domestic housing demands. So it's still a very nice supply and demand imbalance from an investor perspective. And that, in my view, primarily has underpinned the strength of the UK property market to date and will continue to underpin the market moving forward to ensure it's a very stable place to invest in property. So just looking at some figures from our lettings and management partner, Brick. So what we've seen is, a significant increase in rents across key major cities, Manchester, Birmingham and London. Give a bit more focus on Manchester and London in today's presentation. I've done quite a lot on Birmingham recently. But if we just look at some high level figures here, so the average rental yields in Manchester, 6.7%, 5-year Savills forecast, 21.5%. The average rental yield in Birmingham, a bit less, 5.37%, same growth forecast for Birmingham as it is for Manchester. And then London, naturally a slightly lower rental yield, 4.7%. And the outlook is 17.4% growth. So none of all looking pretty strong, really, in terms of 5-year outlooks, anywhere from sort of 17 up to 21, 22%, which is really, really positive. And these are typically the sort of the 3 major cities that we and our clients look to invest in the United Kingdom. Just a quick snapshot of Birmingham, and then we'll go into a lot more detail on Manchester and London in today's presentation. If anyone wants to find out more about Birmingham and similar discussion on some of the information I present on Manchester and London in a second, then please do contact us directly. So what we saw in Birmingham is actually held up very well last year and really outperformed the wider market. So depending on what you're reading, we saw positive house growth in Birmingham of between 1 to 4% last year, compared to negative growth of 1.1% across the UK as an average. According to Land Registry, we saw new build prices in Birmingham increase by 6.7% last year. So again, new builds outperforming the wider market. And the forecast, as mentioned on the previous slide, is 21.5% growth in terms of capital values. So Birmingham's been very strong, very steady. It's the second biggest city in the UK outside of London, for those that may not be aware. And it's got a very, very strong economy. Manchester, the powerhouse of the north, as is often referred to. Just want to look at some of the key drivers of the city. So if we look at the population, so 552,000 approximately, projected to grow by 56,000 between now and 2034, so over the next 10 years. That's a 10% increase in population, which is very significant. 45% of the current population is under 35. 100,000 students in Manchester, 27,000 those international. So over a quarter of the students in Manchester are international students. And the young population, 45% being under 35, very clear indicator that Manchester is very good at retaining young talent. It's got one of the best retention rates from the universities of retaining skilled labour that come out of the universities, the postgrads, to then go on and work in Manchester. That's really important in terms of fueling the Manchester economy. The average rental yield, we looked at that in the previous slide. I want to have a look at the economy. So 32% economic growth over the last decade. That is really significant. It's It's grown by a third in the last 10 years. It's the largest UK financial centre outside of London, and 85 of the FTSE 100 companies have an office in Manchester. Fastest growing job market in the UK, and voted the most livable city in the UK in 2022. And just remember this stat here accounts for 2.7% of the UK GDP, 2.7%. Compare that to London in a minute. Okay, so just continuing on Manchester. House prices, 2.5% increase in 2024 in terms of the outlook, and 21.5%. We've already been over that in previous slides. Home ownership rate, very important. Never want to buy in a city that doesn't have a strong home ownership rate. 37% of Mancunians own their property. Rents increase of 4% in 2024, so really positive rental growth again. And 21. So the capital growth and the rental growth are pretty much the same over the next 5 years, 21.5%. What often drives property markets is regeneration, infrastructure improvements, big public-private partnerships to rebuild parts of the city. And what we've got in Manchester is a £4 billion Victoria North JV between FEC and Manchester City Council, and effectively rebuilding part of Manchester, and thousands of new homes and commercial retail facilities. So very, very excited, and of course FEC are one of our development partners, so delighted to be working with them. And the shortage of homes, coming back to the supply and demand matter that we spoke about earlier, 170,000 new homes needed between now and 2038, and unfortunately that's just not going to be delivered. So let's have a closer look at London, and I hope this information is useful, because these are really primary drivers in rental growth in property markets, capital growth in property markets, but also the stability of property markets. If you look at a lot of these factors, they'll be fairly good indicators of the health of a property market. So London, 8.9 million, so obviously significantly bigger than Manchester, with projected population growth of 10% between now and 2043, pushing London close to sort of 10 million people, which is ginormous. And 23% of the current population under 35. So what that tells us is that London is an older city than Manchester. Manchester is a much younger city. Number of students, 400,000 students. So in Manchester, 100,000 students. So 1/4 of the students in Manchester as there are in London, and 127,000 international students. There's only 27,000 in Manchester. So London, a real hub for education. It's one of the best education hubs in the world, as you probably know, and almost 500,000 students there. Again, a lot that stay on to work and to fuel the local economy. The wealthiest city by GDP in Europe. The world's top financial centre. It's just kicked New York off the top spot, and it accounts for 22% of the UK's GDP, compared to just over 2% for Manchester. So London, the GDP contributions of London are 10 times bigger than they are for Manchester. So it just shows the real difference in the scale of London compared to Manchester and Birmingham for that. And some really interesting figures in it. In terms of the house price forecast, Manchester, Birmingham will outperform, but London will still benefit from very strong growth, 1.8% this year, 17.5% over the next 5 years. And London obviously offers that security and that protection. It's safe haven, and that's why people buy London. The home ownership rate you can see on here is almost 50%, and it's significantly higher than Manchester. Rents, the London rental market is incredibly strong, and there's just not enough property locally in the UK, anywhere really, to meet the rental demand. But London in particular has a real big rental property prices. In terms of major infrastructure works, we've just had the completion of Crossrail, the Elizabeth line, as it's called. So that's completed. Won't go on about the super sewer network. It's not particularly exciting, but very significant. The expansion of Heathrow Airport, a third runway, which is contentious, but will happen at some stage, just given the volume of traffic that comes into Heathrow Airport. On that point, probably worth mentioning that London's one of the best connected cities in the world. 4 major airports, obviously Heathrow, Gatwick, London City, and London Stansted, surrounding London, which means you can get anywhere in the world from London very quickly. The HS2 line is going to run from London up to Birmingham. That's under construction, and that's going to reduce the journey time from London to Birmingham from 1 hour 30 minutes down to about 45 minutes. So again, that is really significant. And London's shortage of homes, 625,000 homes. On a shortage of 625,000 homes, a deficit of 625,000 homes by 2039. Okay, so hopefully that information was useful. I know it was quite a lot of information, but we're very sort of data and research focused, and I wanted to share that with you because a lot of those are really the key drivers in property markets, as previously mentioned, and give us a good indication of how property markets in the main will fare moving forward. So just a quick look at our portfolio, just a quick snapshot. So we've got opportunities across the Midlands in Birmingham, fantastic development there, Sloane Court in the Jewellery Quarter, Manchester, 2 brand new developments just launched in the northeast, Gainsborough, fantastic development there on the River Trent. Our flagship London scheme, Aspen in Canary Wharf, prime central London development. And then we've got a development with Barratt in London, in Hendon Waterside, multi-billion-pound regeneration project taking place in that part of London. And then for clients looking for diversification, Berlin, clients looking for Euro assets, fantastic market, new development we've got there. And down in the south coast of England in Brighton, which is a fantastic city and a very strong property market. We've got an opportunity there as well. So a whole range of properties, different prices, different investment drivers, different investment cases, and different yield profiles. So by and large, we've got a product for everyone. That's not an exhaustive list, though. That's a list of our core products. We've got a number of new developments which we'll be launching in the coming weeks and months. But it gives you a good sort of overview of some of our products. This is one that's just about to complete in Birmingham. It's a bit of a dreary day when these photographs were taken, but gives you an idea. CGIs are all well and good of pipeline developments and investments, but it's all about completions. And this is Scholars Quarter, where we worked in partnership with King's Crescent Homes to build 100 1- and 2-bed apartments. Really excited. I was there last week on Wednesday, seeing it all come together. The show apartment looks fantastic. The finish quality is excellent, and just really, really excited for our clients who will soon take ownership of their units, and we're very much looking forward to getting them on the market and getting them tenanted as soon as possible. So a couple of slides in closing. Just wanted to really show this to show how the UK property market has performed over the last 70 years when compared to some other asset classes. So the UK has delivered average annual returns of 7.3% per year, which over the last 70 years on average has outperformed the Dow Jones, the Nikkei, UK cash. Doesn't do much in the bank account in the UK still, even with inflation, whereas gold and the FTSE. So, of course, one always wants to have and needs to have a well-balanced investment portfolio, and certainly not suggesting that one should put all of their money into property. You need diversification, but UK property is a fantastic asset to have in your investment portfolio. especially for our clients based in Nigeria, given what's happening with the Naira currently and the huge devaluation that we're seeing there. It offers, asset protection, security, and, it will deliver very strong, steady returns over the next 5, 10, 15, 20 years. A lot of our clients use UK property as part of their sort of education planning for their children, buying property, buying well, making a profit, and using those funds to fund a child's education in the future. So we're experts at doing that, and we'd be delighted to have some conversations with our Nigerian clients and anyone from any other country that's attending this webinar on a one-to-one basis. I will be in Nigeria towards the end of next week, and look forward to catching up with all my customers whilst I'm there. If anyone would like to arrange a one-to-one meeting, then of course we can organise that for you. So in conclusion, what do the figures tell us here? The figures that we've just looked at. They tell us that the UK is still and will continue to be a very safe and steady arena in which to invest in property. It's the #1 property market globally for international investors. And we feel that now is an opportune time to buy whilst the market is still at a relative low before it goes to its next peak. As that renewed optimism and confidence is flooding back into the UK market, which we've already seen, that will continue to drive the capital growth over the next 4 or 5 years and the rental growth. So we believe now is a fantastic time to buy. Buying off plan also, we believe, offers significant benefits. Mortgage rates are still a bit higher. At the moment, with on a good day, probably going to get 7% for our Nigerian-based investors, depending on their financial circumstances. Maybe a bit more. That will come down significantly over the next 12, 24 months as base rate falls, and that will obviously have a very direct impact on the cost of borrowing for our investors. And the supply and demand fundamentals I've mentioned earlier, they're not going away. We've got a housing crisis, and unfortunately for renters and first-time buyers locally, it's very challenging. But in terms of being a landlord, it's a very positive time for people to hold UK property. So, that's all well and good. The UK is great, fantastic place to invest. But why should you do it with the RPA Group? I firmly believe that we offer our clients the best service and the best product, quite simply. Me personally, being a specialist in assisting clients in Africa, I understand the nuances of the local market, the challenges of investing cross-border from the likes of Nigeria or South Africa or Zimbabwe or wherever it may be, Kenya, into United Kingdom. And that's really where we add the most value for our clients, is the expertise and the experience we have in successfully handling these transactions. Notwithstanding that fact, we've got a fantastic track record, almost 5-star ratings on Trustpilot, 4.8. I believe we are currently over £1.3 billion invested on behalf of our clients. We've got global reach. We've got clients in every continent. We offer that end-to-end service, and we're very much here for the lifetime of your investment, not just for the upfront sale. And 65% of our clients buy more than one property with us. So that really speaks for itself. It's a great accolade that we're very proud of. Hopefully, is a great testament to the service that we provide for our customers. So should you wish to arrange a follow-up meeting, a one-to-one consultation, either remotely on Zoom or Teams or in person, when I'm next in Nigeria, and my colleague Spencer Grukowski is also coming with me. So should you wish to meet with either of us, you can scan that QR code, and that should hopefully take you to a link to book a meeting. Alternatively, more traditional route, sends an email, info@therpagroupllc.com. And I see there's about 170 people that joined, quite a few customers. So if you are a customer of mine, by all means, obviously contact me directly. See, there are a few questions, and I think I've covered it in terms of mortgage rates, lettings and management. What's this there? Void periods. It depends, really. Typically anywhere from 2 to 4 weeks. Find to rent a property, could be a bit more if it's over Christmas. How do you ensure the quality of product? I suppose quite simply working with the best developers, making sure that we go and look at all their previous developments before we take them on as a development partner, and make sure that the product they deliver is best in market. We also do a snagging check at the point of completion to make sure that the quality of the product is delivered in line with the contract of sale. And then if anything is not right, then a snagging list is presented to the developer to put it right. So once again, I'd like to thank everyone for their time. Thank you for attending. Thank you for your questions. If any questions were missed, I do apologise. Please, we'll try endeavour to come back to you on those directly, or please do, of course, get in contact with us. Wish everyone all the best. Please take care, and we look forward to seeing you again sometime in the near future.